Hello everyone. Today let's look at Chapter 9, Non-Taxable Exchanges. There are some transactions that when we exchange one property for another property, and in this transaction there is no recognized gain or loss, or in another word, we don't have to pay tax on that. So we call it non-taxable exchanges. Okay, now let's look at the example here. So Sandra owns ABC stock with a fair market value of $1,000 and a $200 tax basis. Now she wants to rebalance her portfolio, so she wants to sell the ABC stock and buying XYZ stock for $1,000, the same fair market value. Now, as you know that her basis on the ABC stock is $200, and now she sell it for $1,000. It means that she gains $800. Okay. Now, if she has to pay tax on this $800 gain, she will not have enough money to buy XYZ stock. Okay, so if the government say this transaction is non-taxable, all right, because she used the same amount 1,000 to invest in XYZ stock after she sell ABC stock. If the government say if this transaction is non-taxable, then she will defer paying tax on the $800 gains, and she can use the whole $1,000 to purchase XYZ stock. Okay, so this is called non-taxable exchange. Now, there are some common characteristics for the non-taxable exchange transaction. The first characteristic is that the exchange of one qualifying property for another. It means we exchange one qualifying property for another property. And the second one is that the properties of the exchange should have the same fair market value. For example, if you exchange a car for a truck, the fair market value of the car and the truck should be the same. Okay, if it's not the same, then the other party have to give more money, all right, and make sure that the amount of exchange should be the same. Otherwise that transaction cannot happen. And the third characteristic is that in a non-taxable exchange, the realized gain or loss will not be recognized, not recognized. All right, it's not recognized. So three characteristics: we should exchange one qualifying property for another, and the fair market value of the properties should be equal. Realized gain or loss will not be recognized. Okay, but then if you sell the property later in a taxable transaction, then the non-recognized gain or loss will be deferred until this qualifying property is disposed. It means it's selling in a taxable transaction. It means if you sell this property later in a taxable transaction, then you have to recognize the gain and loss and pay tax on that. Okay, now let's look at the first situation. If there's no boot is received. Okay, boot is mean the cash, the money, or when the other party pay your debt. Okay, we call it boot. So if there's no cash here, all right, the basic of the property received will be equal to basic of property surrender is the first formula, or it can be equal to the fair market value of property received minus deferred gain or plus any deferred loss. So two formula to find out the basic of property received. This will be equal to basic of property surrender or fair market value of property received minus any deferred gain and plus any deferred loss. So let's look at the example of Sally and Lisa. Okay. Now Sally exchanged a property that had fair market value of 100 with basic of 60, and Lisa exchanged a property that had fair market value of 100 and basic of 110. Now you can see that both of these properties should have equal fair market value 100. Yeah. So let's look at the realized gain. Okay. Now, if this transaction is a non-taxable exchange, all right. Now look at the realized gain for Sally. So Sally sacrifice. Okay. Sally surrender an asset that have a basic of 60, and she will get an asset that have a fair market value of 100. Okay. So it means that she will have a realized gain of 40 because this is a non-taxable exchange. Her recognized gain will be 0. Okay. And because she realized gain 40, recognized gain is 0. She don't have to pay tax on any gain. So her deferred gain will be 40. Okay. Now, how to find the new basic? Okay, so we look at the formula here. The new basic will be equal of the basic of property surrender. So the property of that Sally surrender is 60. Okay. Or another formula is it will be the fair market value of property received minus any deferred gain. So the fair market value that Sally received is 100, and then we minus deferred gain 40, and that will give us the new basic will be 60. Okay, 60. Now let's look at Lisa. All right, Lisa give give off the excess that have uh, basic of 110, and Lisa will get the assets that have the fair market value of 100. So in this case, Lisa loss, realized loss will be 10. Okay, realized loss will be 10. Because this is a non-taxable transaction, then she will recognize no loss. She don't recognize any loss. So the deferred loss will be 10. Okay, and the new basic will be equal to the basic of property that surrender, which is 110, or it will be equal to the fair market value of property received 100 plus deferred loss 10, and that will give you the new basic is 110. Okay. All right. Now let's look at the second situation. If boot is received, boot here is mean cash. Okay. If we receive cash, what happened? Okay. Now there are situations that the property doesn't have the same fair market value. Okay. So in this case, another party will give you some cash or some boot. So we say that boot is any non-qualifying property in the exchange. It will include cash or the relief of debt. Okay. And remember that relief is treated as boot received by the party that relieve the debt, and boot pay by the party that assuming the debt. Okay. And the realized gain is recognized up to the fair market value of boot. But remember that boot cannot increase the amount of realized gain, and receiving boot does not cause any loss recognition. Okay, just remember that boot doesn't increase your amount of realized gain, and it doesn't cause any loss recognition. So the formula for the taxpayer who received the boot, basic of property received will be equal to basic of property surrender plus any gain recognized minus fair market value of goods received. Okay, minus fair market value of goods received. Or the second formula is fair market value of property received minus deferred gain or plus any deferred loss. If you are the taxpayer who paid the boot, the basic of property received will be equal to basic of property surrender plus any fair market value of boot paid, or uh, the second formula will be is equal to fair market value of property received minus deferred gain or plus any deferred loss. Okay. Now let's look at example here. For example, Luke and Robert, they are exchanging the properties. Luke exchanged the property that have a fair market value of 1,000, basic 700 for Robert, and Robert exchanged the property that have basic of 280, and Robert also give cash of 100, and the fair market value of Robert assets is 900. As you notice that the fair market value should be equal. So the fair market value of Luke property is 1,000. Because Robert, the fair market value is not equal, it's only 900. So that's why Robert have to pay cash another 100. So this 100 we call it as boot, all right? And Luke is the one who received boot, and Robert is the one who paid boot. Okay. Now remember, when we receive boot, we will have to recognize gain up to the amount of boot that we receive. But remember, for Robert, because he paid boot, so it will not trigger any gain recognition. All right. So let's look at Luke. Now Luke has a basic of 700. Okay. Luke have a basic of property 700, and he exchanges for Robert to receive the property that have fair market value of 900 plus cash 100. Okay, he received this. All right, class. So how much will be his realized gain? How much would it be his realized gain? So the realized gain will be equal to 1,000. It will be 900 plus 100 minus 700. That will be 300. And because Luke received boot of 100, so we have to recognize gain up to the amount of boot 100. And because we realize gain 300, we recognize gain 100. So it means the deferred gain will be 200. And so let's calculate the basic of the property that Luke received. So the basic of the property that Luke received will be equal to, I'm going to use this formula, okay? It will be equal to fair market value of property received minus any deferred gain. So the fair market value of property that Luke received will be 900 minus deferred gain 200. So the new basic will be 700. Okay. Or you can also use this formula. It will be equal to basic of property surrender plus gain recognized minus boot received. So basic of property surrender is 700. Okay. 700 plus gain recognized is 100, and minus fair market value boot received, which is 100. So 700 plus 100 minus 100, that will also be 700. Okay. Now let's look at Robert. Okay, let's look at Robert. So Robert has a property that has basic of 280, And he also sacrificed cash of 100 so that he can get a property that has fair market value of 1000. Okay, so in this case, how much would be the realized gain of Robert? So we take 1000 minus 100 minus 280, and that will give us 620. Okay, now Robert is the one who paid the boot, the 100 cash here, so we don't recognize any gain here. Recognized gain will be 0. Okay, so realized gain 620, and there's no recognized gain, so his deferred gain will be 620. And so the new basic of Robert will be, you remember the formula, it will be fair market value of property received, which is 1000. Okay, and minus deferred gain, which is 620, and that will give you 380. Okay, 380. If you use the first formula, basic of property surrender plus gain recognized minus fair market value of boot received, so it will be basic of property surrender is 280. Okay, 280 plus gain recognized is 0. Um, Sorry, it will be basic of property surrender plus fair market value of boot pay. So basic of property surrender is 280 plus fair market value of boot pay is 100. So that will be 380. All right, let's look at another example. So if there's a relief of debt, okay, remember the relief of debt is also treated as boot. Okay, let's look at the example here. All right, let's look at the example here. Example, I have Susan and Ginger. So Ginger and Susan, they are exchanging property. All right, Ginger has a property that has fair market value of 200, basic 120, and market of 50. The market on the property. It means Ginger is has a debt on $50 on this property. Now Susan exchanged a property that has fair market value of 150 and basic of 110. Now you see that because of the fair market value, they are not the same. So Susan says she agreed to pay the market 50 for Ginger. Okay, we say that Susan assumed the debt, okay, or the market for Ginger. And Ginger is the one who is relief of debt. Okay, or another way, Ginger received the money, okay, for the debt. So how can we find out the realized gain? All right. So Ginger sacrificed a property that have basic of 120, and she get a property that has a basic of 150 plus the relief of debt of 50. So it means her realized gain will be equal to 150 plus 50, the relief of debt, minus 120. So Ginger will realize gain of 80. Okay, we realize gain of 80. Does she recognize any gain? The answer is she will have to recognize gain because she's the one who relieved the debt. And is the relief of debt is treated as boot. So she received the boot. So she has to recognize up to 50. And how much does she defer gain? So because her realized gain is 80, but she recognized only 50, so it means that she defer gain 30. What is the new basics of her new assets? So her basic will be equal to the fair market value of property received, which is 150, minus deferred gain 30, and that will give you 120. Okay, so her basic on the property received will be 120. Now let's look at Susan. Let's look at Susan. So Susan sacrificed an assets that have basic of 110, and she also have to pay for $50 of debt. Okay, and so that she can get a fair market value of 200. Okay, so in this case, you can see she's gaining 200 minus the basic that she sacrificed 110, and also she have to pay 50 cash for the debt, so she gained 40. She gained 40. Okay. Now, Susan is the one who paid the boot or the market, so she doesn't recognize any gain. Okay, her deferred gain will be exactly 40. Okay, and the new basics. How much will be Susan new basis? Okay, Susan new basic will be equal to fair market value of property received, which is 200, minus deferred gain, that will give you 160. So the new basic for Susan will be 160. Okay. All right. So that will be the example for non-taxable exchange. You notice for me two situations: when there's no boot and when there is a boot. The boot can be in terms of cash, or the boot can be in terms of debt relief. All right. Okay, thank you everyone.